Welcome back to the Deep Dive. This week, we're tearing into the sources for October 19th to the 25th, 2025. And what a week. It was really defined by, well, complete contradiction.
Yeah, it really was. You had the market hitting these, frankly, intoxicating new highs.
Right.
But at the same time, the smartest money, the big players, they were flashing these huge neon red warning signs.
The classic behavioral economics playing out right in front of us.
Exactly. We saw the S&P 500 surge past 6,800 points. I mean, that's a massive 40% climb just since April.
Incredible. And all of one piece of data.
Pretty much triggered by it, yeah. A lower than expected U.S. Consumer Price Index, the CPI, that just cemented expectations for the Fed to start cutting rates soon.
So if you're, the average retail investor, you see that S&P number, it looks fantastic. Like the scoreboard says you're winning big.
Right.
But our mission today is to really get underneath that rally because the sources we looked at highlight this critical divergence. Retail investors pouring money in.
While the institutional fund managers, the pros, they were quietly but systematically selling. Getting out.
Selling into the rally.
Precisely. Rotating assets. Moving out of what they pretty cynically called junk.
To junk?
Yeah, high-risk stuff. And moving into quality defensive positions. That divergence retail enthusiasm versus professional rotation, that's the core paradox we need to dig into.
Okay, let's unpack this then. Why? Why is the smart money fleeing, or at least de-risking, when the headlines look so good, if liquidity is about to get even easier with rate cuts? Why so bearish on U.S. stocks right now?
Well, it boils down to two huge concerns, unmanageable debt and unsustainable bubbles. We really have to start with Ray Dalio.
Yeah.
He was all over X this week, emphasizing the risks. One post got nearly 3,000 likes, just hammer on the dangers of excessive U.S. national debt.
He didn't mince words, did he?
Not at all. He actually compared the current financial state to the kind of fiscal buildup you see in pre-war periods.
Wow. Pre-war. That's incredibly heavy language, especially from Dalio.
It really is. And it speaks to his specific worry about the U.S. dollar, especially with all the geopolitical tension rising.
So what's the connection there? Debt, tension, the dollar.
He argues that things like sanctions, global friction, they inherently reduce the overall demand for fiat currencies globally, especially the dollar.
Okay.
And therefore, gold remains securely held, as he puts it. It's the ultimate hedge, unconfiscatable, against countries basically messing up their own finances.
And he thinks we're running out of time to fix it.
That was his most concrete warning. He said, any serious effort to resolve the debt crisis may be forced by politics around the 2026 elections. He thinks it'll just come too late to prevent major systemic damage.
Right. So Dalio's screaming debt bomb, pointing to gold as the lifeboat. But it wasn't just him, was it? Michael Hartnett at Bank of America also chimed in, but more on the bubble side.
He did. Hartnett piled on, providing the context for the liquidity that's actually fueling this fire. He warned the market was caught in this unstable everything rally, not driven by real profits or fundamentals, but purely by easy money. He specifically pointed to 312 global interest rate cuts internationally.
312, wow.
Yeah, so his point was the market's just detached, floating on liquidity.
And when you mentioned they're rotating out of junk, what specifically did Hartnett mean by that in this context?
Good question. So junk here means those highly leveraged, high beta assets. Think speculative growth stocks that absolutely need cheap debt to survive, low quality corporate bonds, that sort of thing.
Got it.
Hartnett was telling clients, sell this stuff. Aggressively. He even specifically warned about a meltdown risk in the hottest, most speculative area, AI stocks.
Oof. Okay, so sell the speculative stuff, rotate into what?
Quality, high-grade bonds, resilient international stocks. You mentioned Europe and China, and of course, gold.
The gold consensus again. It's striking. Dalio on debt, Hartnett on bubbles, both landing on gold.
Yeah, and Hartnett put a really stunning price target on it, too. Very aggressive. He predicted gold could potentially hit $6,000 an ounce by spring 2026.
6,000. That's not just a hedge, is it? That sounds like a bet on something breaking.
It really is. It's basically a bet on the current debt-fueled system fundamentally cracking.
Well, hold on a sec. If the S&P's up 40% since April, doesn't that have to mean something is going right? Like underlying economic strength, decent corporate earnings. Is Hartnett maybe being a bit too bearish here? Protecting his clients?
That's the friction, right? And Hartnett's point isn't necessarily that the economy is...
Okay, this is where it gets really fascinating for me. Well, the U.S. is grappling with this weird internal paradox: debt fears versus market highs. How are the big central banks, like the Fed and China's PBOC, navigating the geopolitical storm brewing between them?
Well, the Fed's definitely walking a tightrope. Their main priority seems to be keeping that liquidity machine running.
Keeping the party going, basically.
You could say that. I mean, the market, after that soft CPI number, was pricing in a 97% chance of rate cuts by October 29th. That expectation is the fuel for U.S. stocks right now.
And Fed Chair Powell, he sounded pretty upbeat about the economy overall, didn't he? Acknowledging the expansion.
He did, yeah. Gave the market the green light it wanted. But there was a subtle counter warning in there, too.
Oh.
He specifically mentioned that AI erosion, job displacement from AI, is starting to negatively affect hiring in some areas, so a hint of a structural problem down the road.
Interesting.
Plus, the Fed published its H.8 data, that's the weekly check on bank balance sheets and liquidity, and they proposed more transparency in their stress tests.
Which suggests?
It suggests they're aware of systemic risk, even as they're signaling easier policy. So, easing with one hand, monitoring stability nervously with the other.
Okay, so the Fed's juggling. Meanwhile, across the Pacific, China's pushing back against U.S. pressure. What's their strategy?
It's really a dual strategy aimed at deep self-reliance. This crystallized at their big 15th five-year plan symposium, October 23rd to 25th.
Right, the five-year plan. That's their main policy blueprint.
Exactly. And President Xi Jinping was emphatic. Mandatory self-reliance in technology, demanding high-quality development. It's basically their long-term shield against U.S. tariffs, supply chain disruptions, all of that.
And the People's Bank of China, the PBOC, they're backing this up with money.
Yep. They jumped back into bond purchases, injecting 20 billion yuan on October 25th, supporting that domestic push.
What are the global ripples from that? China focusing inward.
Well, China banking news suggested that these efforts countering tariffs, promoting their own currency, could actually result in China exporting deflation, basically sending cheaper goods out into the world as they focus on internal efficiency.
So the U.S. is stimulating demand, maybe accepting inflation risk from debt, while China stimulates self-sufficiency and maybe exports deflation. That leads us straight to trade policy, doesn't it? That seems like the immediate flashpoint.
Absolutely. The geopolitical heat was turned way up this week, which just confirms Dalio's whole thesis about instability.
What happened specifically?
The FT reported serious volatility from U.S. trade policy moves. On October 25th, you had former President Trump announcing tariffs on Canada, a key ally.
Right.
While almost simultaneously, China was actually starting trade talks with the U.S.
So the market's just getting whipsawed.
Yeah.
Tax Canada, talk to China. Who's next?
Exactly. It creates enormous instability. And that's why those gold warnings from Dalio and Hartnett are so loud right now. When global trade is this fractured by policy whims, when supply chains are constantly in doubt,
It forces people to look for something outside the control of any single government.
precisely. Trade instability just erodes trust in all fiat currencies. It makes the anti-fiat trade, like gold, feel like the only sure thing.
Okay, so if we sort of agree that traditional stocks are flashing red because of debt, geopolitics, maybe a bubble, the big question is, where else is the smart money looking for returns, besides just gold or high-grade bonds?
Well, that brings us squarely to the digital pivot, because amidst all that macro chaos, Bitcoin showed really remarkable stability.
Yeah, I saw that. It stayed in a pretty tight range.
Very tight, between about $108,000 and $120,000. It wasn't spiking wildly, but it definitely wasn't collapsing either, which suggests, serious underlying strength, maybe less correlation than people thought.
It held its ground while traditional finance was kind of freaking out.
Exactly right. And you had figures like Da Vinci Jeremy reinforcing that long-term adoption message, telling his followers something like, Hody dealing isn't easy, but future millionaires never quit.
The HODL message is strong.
And Jose Luis Cava noted that even at these high prices, Bitcoin seems to have, quote, no ceiling, suggesting the market structure is still fundamentally bullish, driven more by adoption than just pure speculative froth.
But the really seismic shift isn't just retail HODling anymore, is it? It's the big institutions getting serious about tokenization.
Absolutely. That's the key structural change. You have Larry Fink, CEO of BlackRock, the world's biggest asset manager, declaring this the era of the tokenization of all assets. He said this in an interview around October 14th.
BlackRock's saying that. That's huge. What's the appeal for them?
Efficiency, accessibility, transparency. Think is basically saying that distributed ledger technology, blockchain, can do things traditional finance just can't match. It's a total philosophical shift from the top.
And this is about putting real-world assets like real estate or company debt onto a blockchain, but in a regulated way.
That's the crucial part, regulated finance. Cointelegraph highlighted this accelerated global adoption. They pointed specifically to countries in Africa fast-tracking crypto laws and how real-world assets, RWAs, are rapidly evolving towards regulated financial products.
So the digital pivot isn't some fringe thing anymore.
Not at all. It's becoming a structural inevitability, driven by institutional demand for efficiency and, frankly, better plumbing for the financial system.
Okay, so digital assets are one area.
Right.
Are there still specific spots in traditional high-growth tech that experts like, even with all the AI bubble warnings?
Yes, but very selectively. Peruse Saxena, for instance, highlighted autonomous driving.
Self-driving cars.
Yeah, he argued it's at an inflection point, the tech adoption curve plus market seasonality. He thought it looked favorable for a strong rally over the next 4 months or so. He even hypothesized a kind of 1999-style rally specifically in that sector.
1999 style, meaning potentially huge gains, maybe a bit irrational, based on future promise?
Exactly. Which sounds exciting, but also carries massive risk, right? Especially since we keep hearing these warnings about the big AI names themselves.
Definitely. It sounds like a contradiction.
And that risk is very real. Pablo Gil issued a very specific, very strong warning about a potential pyramid structure forming in those super popular high-cap AI stocks like NVIDIA, OpenAI.
A pyramid structure, like unsustainable.
Yeah, suggesting the gains are built on shaky foundations. So the consensus seems to be, if you want tech exposure, maybe look at specific niches like autonomous driving, where the inflection point seems clear, but be incredibly wary of the really concentrated, frothy names leading the headlines.
Okay, so let's try and synthesize all this. What does it all mean? We've got the market hitting records because inflation cooled off a bit.
Right.
While at the exact same time, you have these financial heavyweights sounding terrifying alarms, debt, war comparisons, speculative bubbles.
The synthesis is pretty clear, I think. For you, the listener, there are 3 core interconnected trends to watch. First, geopolitics think Trump tariffs versus Xi's self-reliance push that's deeply tangled up with monetary easing. Fed rate decisions are reacting to trade tensions, and that creates this feedback loop of instability and liquidity.
Okay, instability and liquidity feeding each other. What's second?
Second, there's this really strong expert consensus on diversifying away from just chasing U.S. stock momentum. Both Dalio and Hartnett are recommending a significant hedge, specifically around 15% in gold.
15%, that's a big allocation.
It is, and also a tactical rotation towards international stocks. That lines up with BlackRock's view on, say, APAC resilience, get some exposure outside the U.S.
Okay, third.
And third, that digital pivot is real and accelerating, crucially moving into regulated finance. Bitcoin and crypto remain resilient, anchored by that HO dealing base. But the structural money, the institutional flow, is moving towards tokenization, making digital assets the future backbone for trading regulated real-world assets.
So, putting it all together, the key recommendation for you listening is probably maintain liquidity. Be ready to move fast.
Absolutely. Maintain supreme liquidity for rapid rotations. You need to watch the volatility catalysts, the upcoming Fed FOMC meeting, new CPI data, and be incredibly cautious about that divergence we started with.
Retail buying versus smart money selling.
Exactly. Be wary of buying into a rally that the pros are quietly heading out of.
Okay, so maybe we leave folks with this final thought to chew on.
Yeah, let's do that. Given how severe these debt warnings are, and the observation that maybe global rate cuts are just fueling speculative bubbles, if you absolutely had to choose just one place to park capital outside the traditional US dollar system right now,
Just one choice.
would you go with Ray Dalio's gold hedge? Protection against sovereign instability, sanctions, that kind of thing. Or would you bet on Larry Fink's vision tokenized, regulated assets becoming the new global financial standard? Gold versus tokenization.
This is a fundamental choice about the future structure of finance. Definitely something to think about.
It really is.
All right, lots to consider there. We'll catch you on the next deep dive.
soon.